So today's Cardinal lesson, we're talking about the upcoming 2026 income tax increase. And this is already the law. So I want to give you a little history lesson here. The Tax Cut and Jobs Act was passed in 2017. And it took effect January 1st, 2018. So it was a pretty significant reduction in everybody's income tax. And there was so much wrangling that went on and compromise and throwing things in there, taking things out. And one of the major things that they did to get this thing through is they only funded it for 8 years. Okay. So they had 8 years from 2018 through the end of 2025. That seemed like a long way away when they were passing out the free money or the tax reduction. But 12/31/2025 is not that far away right now. And what I want to get clear is when I talk to people, incoming clients, prospects, just in discussions, people talk about this like it's a proposal, like raising taxes and raising tax rates in 2026 is like one of the proposals that they're talking about. Because there's a lot of stuff floating around right now because it's an election year. People in Congress, the president, people running against the president, they're all talking about what they're going to do about this. And they're going to raise it on these people, but not raise it on these people, and all these different things. And then those are just proposals. And usually at the end of an article describing them, they'll say just that. This is just a proposal. This has a long way to become the law of the land. So what I want to do just at the beginning of this video is I just want to explain to you that the law of the land is we're going to be dealing with these tax rates on this side of the board and these tax brackets. They'll get an inflation adjustment in 2025. But for the most part, we're dealing with this for a year and a half. And then we're dealing with this, and these will be inflation adjusted, because what I got up here is the tax rates in 2017, which was what they're going to go back to. That's the law of the land. It's baked into the law. So if Congress is unable to do anything, which is, in my opinion, kind of likely or unlikely that they are accomplishing getting both houses, the Senate and the House, to agree on the same tax bill and then getting it signed by the president and getting it funded for another 8 years. Unless all that happens, this is what you're dealing with. So, and I want to bring Tom on, and I want Tom to talk about why are we doing this video? Why are we harping on about what's happening in 2026?
Yeah, I mean, you right now have a window of time to get money out of your IRAs, out of your 401ks at a lower tax rate than what it will be come 2026. So in other words, taxes are on sale, and it's going to take an act of Congress to change that. To have that not happen, it's going to take Congress to act, which again is our opinion is very unlikely. So let me pull up the show notes. You can find these below our video at the link. They're also on our website. We have the board like always. And then what we've done is we've gone through, and this is a sheet that we use daily in our practice, but it really up here has the tax brackets for the current year, 2024. There's other things on the sheet, but right now we're mostly focused on that. We then went back and put in what the 2017 tax rates were. Now, with a little bit of a caveat, is these are adjusted for inflation, so these won't be exactly the dollar amounts to get to those brackets come 2026, but the percentages will certainly be the same. And so we'll compare those here in a second when we get back to the board. But I just want to make that point. And then this is, I think, really interesting, is this looks at the top marginal bracket historically in the United States. And so you can sort of look at where we are right now. The top marginal bracket is 37%. It's going to go back to 39.6% come 2026. But I think it's helpful to get a sense of where it's been historically to get an idea of what maybe could happen. We don't know what the future holds, but when you start looking at where we are from a deficit standpoint, our national debt, our opinion is they're going to have to raise rate taxes at some point to help pay for all this stuff. So right now we have taxes on sale. It might make a lot of sense to take money out of your IRA 401k, either do Roth conversions or something else with that to really just get the whole idea is we just want to get the money out at the lowest tax rate possible. So let me turn this back to Hans. We'll go back to the board and we'll sort of go through looking at some specific spots where these tax rates are there might be some opportunities here.
Okay, so this is what we're dealing with right now. The 2024 income tax brackets, the 10% rate at the lowest, 12%, 22, on up to 37% for married, joint, and then for single. And a common misconception about these rates is people look here and they say, well, we make about 150,000 between the two of us. And it says there, we're right in here, we pay 22% tax rates. But if you go through some of our other videos and we actually plug people in and their incomes, they pay a lot less than 22% to the federal because of all the deductions. And then also they get to fill up the 10% bracket, they get to fill up the 12% bracket, and then some of their money is taxed at 22%. So brackets matter. And we don't want to get too much into the details of the thing, but we really want to publish this because this is the law of the land. This is we know. And when we do tax planning, financial planning, and specifically in the area of Roth conversion or just distributions, and then putting it in a savings account and paying the taxes, there's a lot of folks coming to us for advice on doing just that. And so we get this sheet out and we use it. So the purpose of this video is to tell you what's coming. And I can't promise you that these are exactly what the tax rates are going to be in 2026 because Congress may very well act and the president may very well sign it. And somebody may go through and that whole body and the governmental body will alter this. But how successful have they been in getting just about anything passed, especially a tax bill, which has to originate in the House and come up through the Ways and Means Committee? But possible, but the current law, as it states right now, these are the brackets. The 10 is going to go to 10, the 12 is going to go to 15, the 22 is going to go to 25, the 24 to 28, the 32 is just going up 1 to 33, the 35 is staying at 35, and the 37, as it is now, is going to 39.6 on all the income above a threshold. Now, these are the 2017 income tax rates. And just for your reference, this is exactly what they were, and these are the brackets. Now, I tried to find somebody from a credible source that had actually projected these brackets after they do the inflation increase, because when this sunset happens and the increase is enacted, these are all going to be inflation adjusted. And so I couldn't find anybody from a credible source that actually did that publishing. So I decided not to do it myself because so what I've come up with is a number between 30 and 40%. And because you could take any number in the brackets, the married, joint, or the single, and increase it between 30 and 40%, and that's what the brackets will be. And so why do we study this in so much detail? I mean, it goes to what Tom is saying, is we have clients that have substantial money, it's substantial to them, in an IRA. They're concerned about the future taxation. They don't want to pull any money out of it because they don't want to pay taxes now. And this is understandable. They haven't pulled anything out ever, but now they're getting ready to retire or they're retired and they need to pull it out and they need to pay taxes on it. And what we can do and we can help them and advise them on is a Roth conversion. And so I'm going to give you one case study. Is we got a married couple who lives in North Carolina. So you got a state income tax that they're going to have to pay as well. And their income is about $150,000 a year, their adjusted gross income. But we're in 2024. It's going to expire at the end of 2024. But during the year, they can do a Roth conversion. They have some pretty substantial money in an IRA. They have a choice to make. They could fill up the 22% bucket to 201,000. So they would convert about 50,000 of their IRA, and then that would be in a already paid taxed account, so that later they could withdraw from that and withdraw on a tax-free basis, which is a pretty nice thing to be able to do. Or they could let that money sit, and then they could pass that to their kids, and then their kids would receive the money tax-free in the Roth. So 50,000 would be one option. The second option would be to fill up the 24% bracket. So that would be do another 180. So now they're doing a $230,000 conversion, and they're paying 24% federal tax, and in the state they're going to pay about 4.5%. So it's a pretty big amount of money to just write a check that you don't have to write. But another video, we could talk about how that could be to your benefit. It's going to lower your taxes on Social Security. Maybe it's going to cause IRMA for 1 year, but then it's going to prevent IRMA later on. We could get into all kinds of things with that, but those are the choices that are in front of them. We could talk about another case study. We have some very wealthy people that have large amounts in an IRA, and they haven't taken anything to this point. They're still not at minimum distributions. And there's one case study, we've got 6 million in the IRA. And he started to really look at this, and he says, the purpose of that money is to give to my kids. And he can just see that inflating, over another 20 years. He's going to hit minimum distributions. They're going to be pretty substantial on an IRA like that. And so if he's going to convert large amounts over the next 2 years, he's got 24 and 25 to do it, and he just starts filling up buckets, he's not going to chip away very far. So we're able to show him that if you wait till after 2026, first of all, the money's going to be inflated. You will have probably grown it some, but let's just assume the same amount. $1 million at 39.6% is $39,600. Excuse me, it's $390,600 of income taxes. At 37%, it's $370,000. In other words, he's going to save $26,000 of federal tax per $1 million. Now, I know that's way off the earth for a lot of our viewers, and I don't want to irritate anybody by bringing that up. It's kind of tough to feel sorry for this guy, but we're advisors, we're fiduciaries, and so we're helping him make the decision. And I'm not going to give you a clue of what we're going to recommend, but our job is to put the numbers in front of him and then to just help him make the decision of how much and when. And the people that have large balances, and even could be large balances, the first couple I talked about, they have about $500,000 of IRA money, and it's very important to them in retirement. And they like the idea of paying some of these lower tax rates. So we use this chart every day, and we're always talking about couples. The same is true with single people as well, is that, people that have an income that are single, that are less than 191,000, say their income is 100,000, and then they've got a substantial IRA. Well, they can fill up the $191,000 bracket, or they could do a 90,000 conversion and just pay 24% federal tax, and then of course their state taxes as well. So I want to bring Tom on, because I know Tom has a bit to say about these two sets of brackets here.
Yeah, I mean, I think it's helpful to look at where some of the sort of the sweet spots are in these differences, and that bracket, the 22 going to the 25, and then the 24 in today's brackets. That's really a sweet spot that we do a lot of planning around, because if you think about it, say you're in the 22% tax bracket, like the first case study that Hans brought up, and we're recommending they convert up to the 24% bracket. They're paying a lot of taxes now that they otherwise wouldn't have to, But a benefit of doing that is we're getting that money out at that 24% marginal rate. Whereas in the future, that 24% rate, or really what is the 22% rate now, will become the 25% rate in the future. So we're getting it out at 24 now as opposed to 25 there. I mean, that's just 1% doesn't seem like a lot, but really we're just trying to get the money out at the least tax possible for you. And the whole name of the game is just getting it out at the lowest tax rate we can. Sometimes we have clients where maybe they have more money that's not in an IRA. They have non-qualified accounts, things that maybe they had property they sold and they just have cash and they've invested that. Maybe we're not doing Roth conversions with them, right? We're holding back because when we project their taxes in the future, when they retire, maybe they'll be able to stay in that 15% tax bracket. So we're not doing Roth conversions with them. So this is very specific to the person. Our goal on this video is not to give you instructions of what to go do, really convert up to this amount, because it's really dependent upon what your income is now, what your projected income will be in the future, sort of what your income needs are. And so it's very specific to the person. But that 22, 24, and then 25 in the future, that window is, we do a lot of conversions around that period, that sort of those rates between those brackets. And again, if you have $1 million, $2 million in an IRA, you sort of need to do that amount of conversions to really make a dent in those IRAs, to start drawing down those balances and really help yourself, your future self, when tax rates do go up. So again, it's very specific. It needs to be part of a larger plan. We sort of touched a little bit on IRMA. So, one of the downsides to doing Roth conversions on top of paying the taxes is it could increase your Medicare premium for 1 year, right? They look at that 2 years later on what you do this year, but that's a cost. We need to account for that. We normally don't view that as a stop sign of a reason not to do Roth conversions, but we need to account for that. And then vice versa, right? That also means maybe we've lowered our balances, our RMDs in the future are less, so we don't have to worry about IRMA down the road. And then one other thing that I just want you to think about when we're talking about Roth conversions is what happens when the first spouse passes away if we have a married couple. Because if you look at these brackets, it's not perfect, but essentially they get cut in half, right? You get to those brackets twice as fast as a single person as compared to a married couple. And so if we want to start looking forward, is presumably one of you is going to die before the other. You're going to leave that surviving spouse filing taxes at the single rate, which are much higher. And now we have to worry about them paying a lot more taxes there. That's another benefit of doing Roth conversions if we have a couple that's looking at doing that. So again, very specific to your case, very, needs to be part of a larger plan. So if you're interested, you can call us and we can help build that plan out and really make sure we're doing what's right for you and giving you our fiduciary advice.
Okay. So there's many things that are sunsetting as regards to taxes at the end of 2025 or starting 2026. And we don't have all of them up here on the board. This thing would get too long and confusing, but we do have the estate tax. So what they did in the Tax Cuts and Jobs Act is they doubled the exemption. So it was 5.5, let's call it, $1 million. So if you had an estate of less than 5.5 million back in 2017, you didn't even have to file a tax return. I mean, a state tax return. Now that number is 13,610,000. So if your estate is smaller than that, which presumably most people in America, their estate is smaller than that, they don't need to worry about estate taxes. And it's caused people, high net worth people, some of them to just go to sleep at the wheel. They've got several millions, but they're not threatening that because with a husband and wife with some proper planning, you can double that exemption. I mean, you can get a credit for the wife and then the husband. So, for most of you, this is just not an issue, but I want to make you aware of it. That number is going to be cut in half in 2026. And we're thinking the projected number is about 7 million. Be a little more, 7.2 million is where it comes out at in 2026. And that, then you've got to look at if a person who's now 60 and their spouse is 65, you pay estate taxes when the second one of you goes, so that if somebody has a few million now, or 3 or 4, or 5 or 6, or they're pretty well off between the two of them, and then one of them might live 30 years, how much are they going to have out there when they pass away? Estate taxes very well could be a problem in the future. And this number could come down even from there as they want to raise revenue. One of the places to go is people's estates. And a lot of this raising of it was really around family farms and small businesses where people owned a business or a farm that was worth in the millions, and they had to mortgage it to pay the estate taxes. So they raised all these thresholds up to pretty much exclude those people. Well, now they're bringing them back down. So I just want to give a word of caution. It also, they lowered the rate to 40%, the estate tax rate, and that'll go back up to 45% beginning in 2026. So for these high net worth people, a Roth conversion is a way to lower the size of their estate because their heirs are potentially facing income taxes on the withdrawals from the IRA if they leave it in the taxable amount in order to pay the taxes on the amounts that they have inherited. So a Roth conversion lowers the value of their estate. So, and we have several people looking at that now. So what I want to do is just bring Tom back on, and I want to go over what we talked about. It was mostly taxes today, but how we touched on the 7 worries or the 7 areas. And Social Security is taxed by the amount of your other income. So when you do Roth conversions for the future, and then you subsequently draw on those Roths, you could potentially lower your taxes on Social Security. You're going to raise them now, unless you're not on Social Security yet. We talked about IRMA and Medicare. We talked about 401ks and IRAs. That's the primary move that people are making and it's not just Roth conversions. You could take advantage of these brackets to just draw the money out, pay the tax, and put it aside because you're going to buy something or you're going to make a purchase. If you're thinking about a big distribution to make a purchase out of your IRA, it'd be nice to get that done before 2026. All the math, because you're going to pay less in taxes. We talked about income. We talked about estate planning. And of course, the whole video has been about taxes. So I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.